speakers. So in place of Max, who's on your program, we're really delighted that Graham Scott was willing to accept the invitation at extremely short notice. So we're extremely grateful to Graham for being willing to stand in. Many of you will know Graham. He probably needs no introduction to most of you, but I'll give a very brief one just because you don't have his bio in front of you as you do for our other speakers. He was a previous Secretary to New Zealand Treasury from 1986 to 1993, and those of us that look at economics and economic reform in New Zealand know that that was an absolutely critical time to be involved in that sort of an agency. Graham has held various health leadership, a diverse set of roles, including in health since then, and he's currently a director of Sapere. So thank you again, Graham, for being willing to step in at close to zero notice, and we'll really appreciate the insights and wisdom that you'll bring to our discussion. Our ladies are still with us. They managed to get the flights without incident, so I'm delighted to introduce Sandy Lowe from PwC NZ, specialises in tax policy. Welcome along here. And Professor Lisa Marriott of Victoria University is our third panellist today. So 5 minutes opening comments for each of our three speakers, and then we're open for questions. Please be aware that there's a different Slido link for this session to the other session. Okay, so make sure that you're entering your tax questions on the correct Slido link when you go to it. Otherwise, it's going to be a wee bit troublesome for Matt and I when I start asking demography. You might have a go at the demography questions, and these guys might have a go at the tax questions, but if you could enter your questions online through the correct link, that'd be perfect. And if you could also signal if there's a particular person you'd like the question directed at, please feel free to signal that, and I'll do my best. So without further ado, Graham, could I ask you to open?
Well, thank you, Anna. Can you hear me? Is that right? Yeah. Thank you, Anna, for inviting me to this exciting new edition of Economist Theatre Sports. You have 3 minutes on the subject of tax starting now. I'll talk about what I did learn, because I was in the centre of a major tax reform in New Zealand in the 1980s, and what I learnt there, I mostly haven't unlearnt and still think is relevant, and so I'll talk about some of those things. So as you and others, the other speakers here, contemplate what running the tax system differently might mean, I'd ask you to remember some of those things that we learnt last time we did it. You're all too young to remember, or almost all of you, just what the tax system was like in the early 1980s, where we had a proliferation of rates on that were different across all kinds of things. We had sales taxes that accumulated on layers on layers. We had a tax system that double taxed corporate income and a whole lot of other problems that we had in the system. And it wasn't collecting enough money, and it was grossly distorting. To give you just one example, one of the reasons that Sir Robert Muldoon put a tax on pleasure boats that wrecked the industry, stopped it in its tracks and set it back for years, was that it wasn't recorded in the CPI. And that's the way tax systems were done in those days. The Finance Minister, Bob Tizard, put a prohibitive tax on women's cosmetics because he thought they were a frivolous luxury. And thank goodness we've left that behind, but I wave that flag just in case anyone's inclined to think we should just load the tax system with a whole lot of things. We could end up in a place where you're going to have another reform. So what did we learn there? Well, those of you who know anything about tax know about the Ramsey rule. The basic idea is the perfect tax system is the one that levies the taxes in the places where it'll have the least impact on people's behaviour. And so why don't we do that? Well, the answer is we don't have the information to do that. Besides which, even if you had it momentarily, it moves. In other words, if you've got somebody who's, let's say, a professional doctor with a practice, and you can probably raise their tax rate considerably before they reach a point where they say, to hell with this, I'm going to Australia. Might take a bit of time, but it'll happen. So where we ended up back there was a pragmatic solution, which was called broad bases and low rates. And it has a lot going for it, because it doesn't assume you have information about tax incidents that you'll never have, and it minimises the effect of unintended side effects, which always happen with all taxes. And so the lower the taxes, the less those are likely to be. So there's something to remember. My second point is that a lot of the debate and conversation about tax that's taken place in New Zealand in recent times is ideology dressed up as a tax proposal. And it will always be thus. Public policy is about ideology as well as technical analysis. But I think in tax, it's a fiercely complicated set of analytical techniques that you need to really understand the effects of changes in tax systems. It isn't something that the ordinary taxi driver or hairdresser intuitively knows. There is room for expertise, even as though ultimately tax experts all have ideological preferences like anyone else. But I would suggest that the poisonous impact of postmodernism that's crept into New Zealand, as it has in all the great democracies around the world in recent times, is pressing the idea that policy analysts and experts generally don't know anything much, and that science is just a kind of Western sociological and ideological idea. Now, if that's true, then we might as well close this panel now. But I'd maintain that even as though tax analysts have their personal preferences they can express in elections like anyone else, they do actually know something if they're properly trained and can provide politicians whose job it is to impose ideological preferences by giving them better analysis of options of what might happen if you do this rather than that. This brings me to the important point of the comparative advantage of the tax instruments over anything else. It's very easy for people, and perhaps we heard a bit of it this morning with the references to industrial policy. It's a bit easy to say, if you've got a really good idea, let's throw the kitchen sink at it. We'll have something from tax, something from subsidies, something from this, something from that. Let's all focus on that and put all the instruments of policy behind it to make it happen. Well, the trouble is, if you try to do that with everything, you get chaos. And so the tax system is very good at doing some things, and it's a very poor way of doing other things, in particular because it's totally open-ended. And if what you're trying to do is to benefit a particular group in society who are underprivileged in some way or struggling with a disadvantage of some kind, whether or not you use the tax system does take into account, well, exactly who did you want to reward and how much did you want to reward them by? And that's often very poorly done in the tax system, which makes the effects available universally for everybody. So the principle of comparative advantage applies, and I suggest that a lot of the tax debate we've had in New Zealand about income distribution and so on hasn't been carefully enough thought through in terms of what can you do with the tax system and what can you do with things that are better suited to the job. My final point, this is about the management of the tax system. And I think that the tools and techniques that have emerged under the heading of social investment have a lot to contribute in tax administration. Now, social investment got called social investment because it arose inside the Ministry of Social Development, concerned with what were the long-term impacts of particular situations people found themselves in down the track. But the same mathematical and analytical statistical techniques can be applied to a lot of other things. In the case of tax, those of you who pay GST in the room will be aware that in recent years your refund on GST has been arriving a day or so after you put in your return, whereas it used to take a couple of weeks. And the reason for that is that Inland Revenue is using these kinds of techniques to discriminate between people who it's a waste of time investigating and concentrating their resources on people who deserve to be investigated. Now, artificial intelligence will power up these kinds of techniques in ways yet to be discovered. But I think there is a real possibility there of using AI and associated analytical methods to become much more targeted in the way in which Inland Revenue can chase the people who are not paying taxes they should pay and leaving the rest of us alone, as has pretty much happened with GST. So there's my 3 points, and I'm happy now to sit back, and Professor Scrimger will rescue me from any hard questions you ask that I can't.
Thanks very much. Sandy.
Thanks, Anna. Kia ora koutou. Look, the session today is called Running Tax Differently, as we've already mentioned. And for me, actually, I'm probably along the same spectrum as Graham, actually. I don't really think we need to run tax that differently here in New Zealand. And look, why I say that? Well, let's just set the scene and say that the basic premise of why we need a tax system is for a country to collect enough revenue so that it can run itself in the way that it wants to do. Now, I appreciate that's a bit of a circularity in that statement in itself. The question of how much money do we need, how much money we want to spend will determine how much money we need. And I'm going to confess, I am definitely not qualified to answer either of those questions, but hopefully the Minister of Finance might have given her thoughts on that early on today. But what I do know is that New Zealand's tax to GDP has tended to track a little bit below the average for the OECD countries over the years. But actually, over the recent years, it's been sitting pretty close to that OECD average. Well, what does that suggest? I guess that, for me, that would suggest that we're probably not too out of whack in terms of how much tax we collect. And the other interesting reference point is that our net debt position as a nation, it's probably a lot healthier than lots of other countries as well, which again suggests that the balance is probably not too out of whack. But obviously there's been a bit of media around some of the recent commentary that's come out from the Treasury, which, and over the last couple of years now, they've been telling us that we, as a nation, have been spending a little bit more than we are earning, and so we really do need to crack down and buckle up and need to focus to get back to surplus, which in really basic terms I think it means either spend less money or make more money. But if we set those last few years aside, being quite unique, being COVID and floods and all sorts of things, and if we assume that the spending side of the equation is about right, I think that leaves the last question of, well, is our tax system collecting tax as well as it can? And Graham's already mentioned, the efficiency point. You want to have a system that creates less distortion as possible. And if we apply those things, I would say, I think the overall structure of the New Zealand tax system seems to be pretty sound. And I guess this is something that's come through in a number of the recent tax reviews that's gone on, with the last one being in 2019. They all found that the general structure of the New Zealand tax system is okay, but recognising it did recommend to some changes might need to be made. Overall, I think, as Graham's already mentioned, broad-based low rate seems to be still a pretty good, sound general premise for us, as it generates the required revenue without too much fuss. But look, as we all know, there are some probably key gaps and challenges that as we look ahead in terms of continuing to use this broad-based low rates system. Jumping right into it, I think the first one is the taxation of capital income. It's a key area which brings into question whether we do, in fact, New Zealand have a broad-based low rate system. Another key observation is New Zealand is strongly reliant on taxes on individuals. I think for 2023, for the 2023 year, the total tax take was about 104.5 billion, with over 50% of that tax revenue coming from individuals' tax, most of it being PAYE. That indicates a very strong reliance on tax on labour. The challenge with this is that with our changing demography of New Zealand, which is being talked about out there, I guess, what it all means is that we're going to have less people working. So the ones that will be generating that tax revenue, and the balance will shift, that we'll have more people not working versus those that are. So the key concern will be, as we look ahead into the future, are we going to have enough people bringing in the amount of revenue that we need to continue to run the country as we have it at the minute. The other piece is, I think, if we take that into consideration, I think there is still merit in continuing on with our broad-based low rate with those key changes. One of the things we've been thinking about, that we've been hearing a lot about, is some of these other taxes that's been thrown into the mix, inheritance taxes, wealth taxes, or the minimum tax that was thrown around by the previous, in the previous government term. To me, if we are in agreement that our broad-based low-rate general system is still doing its job relatively well, it might make sense to think about expanding on the basis that we currently have in a consistent manner to the system that we have. The things that I've just rattled off are quite different to the income tax system that we have. In particular, wealth taxes and inheritance taxes requires tax to be paid even if you haven't got the cash in hand, which brings some, interesting issues if we were to go down that route. But overall, I think if we took a step back, I don't think we need to do much difference. Need to do tax too differently overall as a system itself. But one of the things that I do think it might be worthwhile to think about doing differently is whether there's merit in taking the politics out of tax, possibly. And I know that might be a bit get a few laughs because it's hard to take the politics out of tax, but I think it's a worthwhile idea to think about that. And the reason why I suggest this is that over the last few years, I think one of the key things that's been ebbed away is the certainty of our tax system. Having an uncertain environment is not great for business. Taxpayers would like to be able to work out relatively with some certainty what tax they're going to pay, what kind of taxes they'll have to face. No one really wants a tax surprise. And so any changes should really be well signalled. And then the other piece, the other more potentially damaging thing is not so much a tax surprise itself, it's the constant changing landscape and whether including whether something that's proposed will actually eventuate or if something that's been in place gets immediately repealed a couple of years later. All of those things are not, provides some challenges to New Zealand as an economy, I think. And we've got plenty of recent examples of those being, the GST on platform is one it's a really live example where we're seeing businesses really grappling with trying to implement these rules by 1 April this year when all along, throughout the election period, it was will they, won't they, been told that it will get repealed, but now all of a sudden they're back in. So, that's not great. That's a really small example, but, puts challenges for businesses as they are trying to navigate. And, with a 3-year election cycle, it's a relatively short period of time. And if we keep having things chopping and changing, I do wonder whether there is some merit in thinking about taking the politics out of tax a little bit. But, it's something I've been mulling over. It's a thing that's probably a bit hard to actually eventuate. But, I thought it would be worthwhile
that
just
might
to...
be something we pick up in the questions as well. Let's move over to Lisa for your opening comments. Thanks very much, Sandy.
Kia ora, Anna. And kia ora koutou. Thank you so much, everybody, for coming along to the tax session. It's always good to know that people are interested and willing to sit through an hour of discussion on tax. So the couple of points that I want to raise actually pick up on bits and pieces that Graham and Sandy have both mentioned. First of all, Graham did mention that the Ramsey tax and the ideal having the least impact on people's behaviour. But what I did want to talk about is behavioural taxes, which are, of course, designed to impact on people's behaviour. And I actually think, and again, picking up on what Sandy said, I think this is one thing we've done reasonably well in New Zealand. If I look to some of the things we've done, maybe it's not the right time to mention tobacco taxes, but some of the other things we've done, like KiwiSaver, for example, relatively low cost, but in fact we've had a significant behavioural change without getting the real unintended consequences that you can have from a tax like that. And I would point to perhaps to Australia as an example of how it can all sort of go horribly wrong and just advantage the wealthy. So there are some taxes where we have done well. I would have said up until fairly recently, environmental taxes, particularly with vehicles. We did manage to get 14% of our new vehicle fleet last year being electric, and of course we are a long way from Norway at over 80%, but the change was happening, and this is where I think the tax system is actually really, or can be really quite effective. However, in order to be really effective, we do need to have some certainty. People need to have certainty to make informed decisions, and this picks up on exactly what Sandy was saying, was when we have the politics and these types of taxes that are intended to impact on behaviour are subject to potential changes every 3 years or 6 years or 9 years, then it's very difficult for people to make informed decisions. If you look at somebody who may have bought an electric vehicle in the last year thinking it would have a particular value on the second-hand market, which it probably doesn't with the changes that were announced in the last couple of weeks. So that's one thing that I think is really important for us to think about. The other one, which is really changing tack completely, is compliance, or actually specifically non-compliance with tax. And this is an individual view, I would like to see Inland Revenue taking much stronger action against people who don't pay their tax, and that's across a range of activity. Whether we're talking about obviously the tax evasion, so the really egregious non-compliance, or whether it's even just people who are making poor business decisions and still finding themselves not in a position to pay their tax. I was looking at Inland Revenue's most recent annual report yesterday, and they give a figure of 213 customers who were granted tax write-offs last year, 213,000. Now, I'm not saying necessarily that any of that is particularly good or particularly bad, but it is inequitable, because the 50% of people that Sandy has just referred to who earn wages and salaries don't have the opportunity to go to Inland Revenue and ask for some of their tax to be written off, and that includes a large proportion of some of the lowest income earners that we have in the country. So there are some real equity issues there. Another figure from the annual report, 400,000 businesses qualified for relief from penalties and interest if they paid their tax. So the penalties and interest are there to encourage people to pay their tax, the amount that's due and on time. But it's pretty well established that actually you can negotiate, and at which point that whole scheme, which is intended to act as an incentive to comply, becomes sort of somewhat meaningless. I've written on a number of things that I think Inland Revenue should be doing, that they could possibly think about to try to, well, actually not even necessarily to encourage behaviour. Some of it is encouraging behaviour, but some of it is also just creating a bit more visibility around people who are non-compliant to a large extent, or repetitive non-compliant, where they will manage a business poorly, it will go into liquidation with a reasonably significant tax debt, and then they will do the same thing again. Because the problem with that is it impacts on, well, employees, it impacts on their customers who don't get the products they pay for, it impacts on the creditors who never get their bills paid. So there is a lot of knock-on impacts there when Inland Revenue has information which isn't shared. So I have suggested that things like credit reporting, so reporting tax debts to credit agencies, potentially thinking about publishing tax debtors' details when they're obviously not every tax debtor, but if they're over a certain amount, over 50,000 or over 100,000 or over 6 months old or whatever it is. A lot of countries do this. They publish this information so people dealing with those organisations can make informed decisions. There are other things I've written about as well: director penalty notices, making directors personally liable for taxes under certain circumstances. But I would like to see Inland Revenue doing more to collect the tax that's actually due. And then we probably wouldn't have to have these conversations about what extra taxes we need, because we'd be collecting what we should be. Thank you.
Thank you very much to our panellists for those opening remarks. It took us on a little bit of a history tour and it taught us that some of those things are still highly relevant. I think there were some common themes that we heard through there, weren't there? The importance of not having distortionary effects of taxation unless that's what we're trying to achieve with our taxation. And also I think that theme of having some certainty, whether it's through managing the political system or just some certainty in terms of what we're going to expect is important, including for the practitioners that have to manage these sorts of things. So we had some great sort of themes, but also some differences. We didn't get a strong sense of the whole taxation system needs to be run completely differently. In fact, our panellists, I think, all kind of said these are more changes at the margin, I guess would be my hearing of that. But let's delve into some of these things in a little bit more detail. One of the questions that I've got is on capital gains taxes. And this question is that capital gains taxes may be very good in theory, but often not good in practice. Could our panellists, and I'm going to direct it to whichever of you would care to take the question first, could you provide any examples of a country that has a capital gains tax that has performed well? And could you give us any broader insights into your views on capital gains tax and the relevance or irrelevance in dealing with issues that New Zealand needs to deal with in tax?
Well, I should say that when I was Secretary of the Treasury, I recommended a capital gains tax to the government at the time in the early 90s, but warned them that the tax they would end up implementing, once they'd thought through the politics of it all, wouldn't be the one I was recommending. And so, on balance, don't do it unless you're willing to do it in a way that actually raises a lot of money and is actually levied on a base that is reliable. You've got good information about it. You can validate that information and so on. And what's happened repeatedly since then is I've had tax spokespeople from 3 different political parties ask me for my advice on capital gains, and I've always said the same thing. The one you'll get isn't the one you've got in mind, and you can end up with not raising much money and creating quite a lot of unintended side effects in the way you have to implement it. And that's sort of about where it sits. I've had no reason to change my mind about that since. I mean, there's all sorts of political arguments, but I'm not particularly interested in those. But I think just in terms of the technical business of designing it and implementing it, it's very hard to get that right. I don't really know of a country that I'd say is a brilliant example to us, but then I don't study this much anymore.
Thanks.
Yeah, I guess the question that I had in terms of that question is, well, what do we mean by good? I suppose is good meaning that it raises a whole heap of revenue. If that's the case, then I agree with what Graham has said. It comes down to the design of the system that you can actually, I guess, sell to the public one way or another. The way I often think about it is, New Zealand has a very enviable GST system, right? It's one that applies to pretty much everything and it's at a consistent rate. But I wonder whether it's based on the political climate at the time, whereby we had a political system whereby I think it must have been first past post, and that the government could just get something like that through. Whereas nowadays with MMP, you end up having a lot more discussions and trying to get things across the line. So, in some ways, I don't know whether it's there is something in thinking about how did New Zealand get such a great GST system in place. That's the envy of everywhere else, and then taking some of that experience and thinking about how we might implement a new tax that's expanding on picking up on some of the bases that we're currently not taxing. So if that is to be taxation of capital income, then have a think about, well, maybe we should be a bit more bold and brave and think about how do we get that across the line as a country.
Maybe where we'll move to now, and in fact, Lisa, this is a question, you can tie in capital gains into this one as well if you like. Progressive versus regressive taxation. How can the tax system be structured to ensure fairness and equity, particularly the balance between progressive and regressive taxation? Of course, equity was an issue that you addressed in your opening address. I wonder if you'd like to respond to that question, please. With or without capital gains tax?
Absolutely. I might just take advantage and say a couple of things on capital gains as well. I think it's a fair question about whether there is an example of one where it's done well. They generally don't actually collect a lot of revenue. So if you look at the amount, even in Australia, if you look at the amount that they theoretically can collect, it's very high. However, by the time you then take off all the exceptions, so the 50% discount for assets that are held for longer than a year and all the losses that are carried forward, some of them going back to the global financial crisis, they actually do end up collecting relatively little. So, whether it's worth it for the compliance costs that sit alongside it, I'm not sure. I'll just quickly squeak in my own personal preference. If you were going to have a wealth tax as some sort of land tax, just because it's a lot easier to identify land and owners, and you can carve out what you want to carve out, like productive land or whatever it is. Progressive versus regressive, I think most tax systems have combinations of both of these, and that to me is fair. For people who aren't familiar with those tax terms, progressive would be our income tax system where you pay more as you earn more, so ability to pay is taken into account. So if you're earning more, you can, at least in theory, afford to pay a higher level of tax. Regressive taxes are taxes, in fact, the economists would probably not agree with me using the word regressive with a GST, but I'm not an economist, so I'm going to do that. And I would say that a GST is regressive because it doesn't take into account ability to pay. So people, the example I use with my students is everybody, we all go into the supermarket and buy the same loaf of bread. We all pay the same amount of tax. It doesn't matter if we earn $10 that week or $10,000. We're all paying the same amount. So the burden relatively is higher on lower income earners. I think having a balance of those is really important because they do have different incentives and impact on behavioural changes in different ways. And again, to go back to what Sandy said, I think actually we probably got our balance about right in New Zealand.
Thanks. I've got a question here. Max couldn't be here. So in his absence, would the panellists like to channel their inner Max and recommend the single tax change they would implement from a socially progressive perspective? Now, maybe it's an unfair one to start with you, Graham. I don't know. Would you like to start, or should we pass it on to...
I would answer it if I had an answer at the tip of my tongue, but right now I don't.
Let's pass it to Sandy. Do you want to make a start? And we can come back to Graham if you get one on your tongue.
I would actually flip that around a little bit and turn it back to the transfer system. So how can we channel whatever... revenue, my really simplistic term is, for those that need it, why don't we work on the welfare system or the transfer system to try and give them what they need, as opposed to thinking about, I guess, that's a tough question because, that would tend to...
We'll call Max back next year and let him address it. Maybe what we'll do then is we'll move on to a slightly different area, investment tax. And I think, Graham, this might be something that you would be willing to comment on. Do we need a tax policy or tax policies that specifically incentivise investment? What tax policies could be implemented to incentivise domestic and foreign investment in key sectors that would foster growth and job creation in New Zealand?
I'd go back to the point I made about comparative advantage, is that should you use the tax system to try to do that at all? If the primary purpose of the tax system is to raise tax, and you don't want unintended behavioural side effects unless they're deliberate in the way that has just been raised, there are some places where that's what you want. But if you're thinking about what is there in the public policy framework in New Zealand that inhibits foreign investment, I wouldn't start with the tax system. I'd start with overseas investment regulations and various other regulations which are creating artificial sources of profit and gain in places that are protected from regulation. Real estate investment being the obvious one. We don't have a problem in the price of houses, we've got a problem in the price of land. So it's scarcely surprising that if you're inducing investors to come into New Zealand and go and buy hotels and resorts and all the rest of it, because of the artificial scarcity of the underlying factors. So I wouldn't have tax at the top of my list of things to do to encourage inward investment, but you'd need to be pretty careful to make sure that your company tax rate was internationally competitive. I mean, you can see the way Ireland's got away with what it's done inside the EU because it turned itself into a gateway into the rest of Europe by having these very low taxes and attracting all these high-tech companies and so on, which isn't available to New Zealand because we're not a small corner of Europe. So I don't think we should consider the tax instrument as being crucial to solving our issues about getting foreign investment, other than making sure that our company tax rates aren't high. We've still got, I think, the advantage, although I know when it comes to international taxes this gets tricky, but basically the idea of imputation, so you only tax business income once in our system instead of twice as happened in the classical system, is a good thing and should be retained, although I do accept that it's very difficult in international tax negotiations.
I agree that I think important point is to make sure we do remain competitive with our other countries, and company tax rate is one that it's important. So as long and it's kind of closely competitive to our close allies. So like Australia, if Australia significantly lower, we wouldn't want to be too far away from them. The other pieces, I think I've made this in my opening comment, is around certainty. I think having certain tax environment is critical to ensuring that foreign investors are happy to come in, so that they can have a really clear idea of what the tax profile will look like in the next 20, 30 years or whatever it is. In particular, if we're looking to, looking at investment in the infrastructure area, say, for example, which is something that New Zealand probably do need a bit of at the moment. So for me, it's not so much doing additional things to be attractive as making sure that we don't have a tax system that actually sort of puts on handbrakes to stop people from coming in.
Quite a bit of agreement there. Let's move to a slightly different area that still ties in with this international competitiveness. Digital economy taxation. And of course, Graham, you mentioned about AI and so on in the context of maybe using that to help the tax system. But let's think about the actual taxes on some of these new technologies, including the digital economy that's rapidly evolved. As that economy continues to grow, what measures do you think are the appropriate measures that New Zealand should appropriately take, including taking into consideration the challenges of implementing laws across international boundaries? So Sandy, let's start with you on this one, please.
Yeah, so look, I think the OECD has been doing heaps of work in this area over the last, I feel like it's almost been a decade, hasn't it? And in terms of the digital economy, they've spent a lot of time talking about working on a globally agreed solution. And look, I think that's still probably the way to go, is make sure, there is international consensus and everyone go at it at the same time, as opposed to putting in unilateral digital services tax and things like that. And the reason why, I would sort of take a bit more of a pause on a digital services tax is on unilateral, I guess, measures by countries like New Zealand, is that, the bigger economies, what sort of retaliation they might have and the likely potential impact it has on our New Zealand businesses that are looking to expand offshore and things like that. So I think it's definitely an area that we do need to rethink our tax rules generally, because those were made based on much more bricks and mortar type economy, and so things do need to change. But I do think that the changing, making sure we're doing it in a cohesive manner along with the rest of the world is probably the best way to go, as opposed to going ahead unilaterally and charging on and implementing a new tax.
And my take on that is we're hopelessly unprepared for this. The Digital Autonomous Organisation, or DAOs as they get called by their initials, seem to me to be the little engine that could spark a wave of innovation in our economy right across it, everywhere. And the thing to keep in mind about these digital autonomous organisations is they are exactly what the name says. They operate without human intervention. The other thing about them is that they blur the distinction between an owner, a manager, and a customer. They have internal voting procedures and so on. So sometimes you're an investor and sometimes you're on the board of directors carrying directors' responsibilities. And I think our tax system and our system for regulating financial institutions is completely blind to what's going to happen. You'll never stop the income that's generated in these things from showing up anywhere around the world that it chooses to go. And you'll have terrible trouble applying a classical system of regulation and tax to get at these things. And I'm really disappointed that there's so little's been done. I know the Reserve Bank's doing a bit. As far as I know, the financial services people aren't doing much. And I know the regulators have barely even thought about it in other aspects, but I think it's something we need to get on top of. Otherwise, you're going to find that the huge holes been blown in the tax system and regulations are being invaded with these things.
Yeah, so certainly something you would think about doing a bit differently from currently. A question in Lisa for you perhaps. What changes do you see, if any, that need to occur within charities in terms of who is tax exempt?
Always a popular one, isn't it? There are certainly questions to be asked around whether big businesses are legitimate charities, even if you can draw a reasonably direct line to, well, perhaps a dotted line to the benefit or where those funds are supposed to go. I think it is a legitimate question to be asked. I'd like to see us looking at that. And there was something that popped into my mind there, and it's just gone straight out. No, Sandy, do you want to add, and I'll see if it comes back.
Yeah, I think, it's definitely one that's bubbled around quite a bit. The question around whether the exemption should apply to a business operation of a charitable organisation. There's for and against kind of comments you might make. The first one that often comes up is whether whether there's competitive advantage for, say, a charitable, a business of a charity against another, just a privately owned business, because then they have the competitive advantage of not having to pay tax. And so, I'd imagine this will be something that's continuing going to be having be considered by officials, I guess. And often with these things, there's always trade-offs, right? And so it'll be interesting to see where officials get to, I suppose.
And let me just jump back in. I've remembered what I was thinking. It's also when you see charities that are accumulating significant assets, and those assets are not actually being spent in the way that they should be being spent, so invested in the particular public good, which is why they're a charity in the first place. So I think there is, again, a legitimate question to be asked where, if you are accumulating assets above certain thresholds, whether the charitable tax benefits should still remain. Yeah. And it goes back to what Sandy said about being competitive.
Thanks, and we've only got 2 minutes left, so I'm going to ask for some brief, and this will be the final question, so you can wrap in your final thought on what we want to do differently as well. But the question I'd like to wrap this around is the potential importance of small businesses in New Zealand to driving innovation and employment. We are a nation of largely small businesses. Are there any things, particularly with respect to small businesses, that you would like to be seen done differently in terms of tax? And if we can have a 30-second answer from each of you that gives the wrap-up, that will be fantastic. Graham?
Just follow the example that's happened with GST. Just leave them alone until you've got reason to think they're cheating on their taxes, and stop loading them down with useless compliance and so on that goes on at the moment, and assume that they're honest until AI picks up a pattern that says actually they might not be.
Well done. Less than 30 seconds. Sandy?
This will be quite strange coming from a tax advisor, but I reckon less complexity would be the way to go. I guess similar to Graham's point is that, businesses, we should let the businesses run their business as opposed to bogged down with figuring out what they should be doing with their tax.
And I would say compliance. I talk to small businesses, and one of the things they say is that it's very hard to compete when they're a compliant business, but actually their competitors are not compliant, and they're getting advantage because, they're not compliant with their GST or their PAYE or whatever it is. So again, sort of the opposite of what Graham has said, which is actually, I think, more focus on compliance by way of small business honesty.
And perhaps we might get some of that with the AI that Graham also mentioned. So we had some different views there. We had some similar themes come through there, but we certainly had some very rich insights into lots of taxation issues. Thank you very much for our audience for making that big step out of the other room and coming and joining us in here. In 4 seconds, we're going to invite you to go back into that room over there and rejoin the main session. But first of all, please, I'd like to extend our sincere thanks to our panellists for their contributions. Thank you very much, and thanks for a great job at such